Good morning and welcome to the Global Morning Call. Today is Tuesday, 25th of October, 2016, and we start with an update from our Asia desk with Kay Van Singapore.
All right, fantastic, Yasser. So good morning and good afternoon on this Draghi and Carney kind of Tuesday. So it was quite interesting. Obviously, we had a very strong kind of risk on across global equities yesterday, right across from Asia over to Europe and to the U.S. And once again, seeing the peripherals in the Eurozone, FTSE MIB, the IBEX, Spain, and the Italian equities outperforming. We still favor kind of downside risk on that in regards to building up put positions, just given the event risk that we have kind of on the calendar. So momentum, I think, still very much up, and even though it's feeling overbought, I think we could see a turn later on this week. But we didn't get that continued follow-through on APAC equities today. It's been a bit of a mixed bag. Australian and Japanese equities have closed for the day. They've outperformed at about 76 and 63 basis points up for the day. So far, China and Hong Kong have been basically flat to down, but no big pullbacks. I think the outlying underperformer has been the Kospi, down close to 50 basis points. It's very, very much noting that we had very strong flash manufacturing PMIs pretty much across the board overnight. US 52.4 was expected. We got a big beat at 53.5. Eurozone 52.7 was expected. We got 53.3. Also very big beats in some of the constituents such as Germany, which saw a very strong beat and also France, which had a big reversal from the sub 50 print that they actually had in the previous month, and again also in Japan. The US basically saw the quickest expansion in 12 months, as well as the fifth consecutive month of growth on these flash PMIs, not to be confused or mistaken for the ISMs. Basically, net, this is showing that we're potentially having a very strong start on fourth kind of quarter growth. Today, again, we are waiting for Draghi and Carney, who will be speaking later on today. I believe Carney will be at about 3:35 Central European time, and Draghi will be a little bit about an hour later at about 4:30 Central European time. So it'll be interesting to see what they say, if we get any shakeups, such as the Paulo's discussion yesterday that sent dollar Canada down almost by over a figure before it reversed back up, as it was alluded to that they may be putting the Canadian rates on hold for about 18 months before he clarified that, and he said that wasn't in regards to monetary kind of policy. So you never know what comes through when you have these head of central banks kind of speaking. We also did have iron ore pure play FMG listed down in Australia, having a very, very big up day on the back of the movements we've been seeing in coal and iron ore in China. This is one of the most levered kind of plays you can see out here, which has been making a little bit of the news around. In regards to kind of the rest of the day, apart from Carney and Draghi, economic calendar is relatively light. Out of the U.S., we'll have consumer confidence as well as the Richmond Manufacturing Index. But the main data points for the rest of the week is really going to be all about U.S. Preliminary third quarter GDP, which will be out this Friday. Markets expecting 2.5%. Which is obviously significantly up and higher than that 1.4% that we actually got at the end of the second quarter. And with that, let me pass it over to Dan Larson, who runs our options desk. Thank you.
Thank you for that introduction. We'll talk a little bit about the implied vol we've seen over the last 24 hours in the options market. First of all, we saw last week that the Eurovol spiked up when we broke below the 109.50 level. Risk reversals are pointing towards the downside as well. So as expected, vols were increasing at the time, but since then the volatility has dropped quite significantly again. Main reason, of course, that there's hardly any follow through over the last 24 hours of the move, but also that that risk reversal probably is too expensive for the kind of move that we've seen so far. So makes sense that the vols have traded lower, and unless we see some follow through soon, then we expect it to trade even lower from this level. At the moment, the euro dollar in our view is sell on rallies with key level 109.50. Same really goes on in the sterling crosses. Sterling vols are still elevated from the sterling collapse we saw earlier this month. But if you look at what's been happening since, I mean, we do see some volatility, but the realized vol are heavily underperforming, especially if you see euro sterling over the last 24 hours. So we expect some further drop in the sterling vols as well. That being said, especially in cable, we are seeing some decent interest to buy upside strikes in the very short end. So there's some players in the market that are worried about either squeeze higher or simply just want some protection against some quick illiquid move higher in cable. Just been looking at a few things vol term wise the last couple of days. We can see that this is a chart of 1 year at the money volatility in euro dollar. It's not even close to all-time low, of course, but if you look over the last year, it's at a relatively low level. And for a long-term view, I think there's good value in getting some vega on the book. We have a lot of stuff coming up. First of all, the US election, then the Italian referendum, and a lot of stuff for next year as well. So in general, we believe that the volatility could be good to have on the books for a long-term view. That's all we have from here, and I will pass it on.
Thank you very much, Dan. Let's pick up on the theme that Kay alluded to about the stronger manufacturing data we had yesterday. It was probably it was the reason why we saw white metals outperform gold for a change. We've seen platinum and silver being under some stronger selling pressure than gold during this past couple of months. But the data yesterday, especially the initial data out of Europe, sparked a jump in silver, and that helped bring gold higher. But as we saw the US data come out later in the day, the gold was sold back down again, because then that US data at this moment is obviously related to the risk of rising rates. So manufacturing data outside the US is good for the metals. If it's inside the US, and it's a little bit more of a tricky one. But at least we're seeing some recovery there. It also ties in with the fact that we're seeing quite a big closure of bullish longs in the market over the past couple of months. In platinum, it's down 86%. In silver, it's down 55% from the peaks we had back in August and September. We also seen that the silver demand through ETFs has continued to rise. It's up 3.5% since silver started to sell off back in August. It's basically currently sitting at a record. So underlying demand for the metals are there, and it could indicate that we have some potential outperformance coming if these data continues to be repeated. But looking at gold, still stuck in the range 1250 to 1280. Well, 1250 1272, which was high yesterday, but really the first big retracement is 1280. That's what we need to break, and further demand above 18 in silver if we can get through that level. Turning to crude oil, frustrating at the moment, range bound. Yesterday we had an attempt to the downside. We did issue a sell idea on that. I'll just come to that. But the market did find support below 50 in WTI and below 51 in Brent, and the market continues to focus on the potential success of OPEC's initiatives to cut production. Overnight, Indonesia, which is the latest member of OPEC, was out saying they were targeting a 42% increase in crude oil production next year. So that's not where they're gonna get a cut from. They are small producers, but it just adds to the number of countries within the OPEC who said that they are not prepared to cut at this stage. U.S. inventories tomorrow will start to receive some attention. It's been a very volatile number the past 8 weeks. Only one out of the past 8 surveys got the direction right. There were 8 surveys in a row looked for a rise in inventories, and we got 7 of them. 7 of them were actually draws, and that has created quite a lot of volatility around the number. But that's for tomorrow. Another one that's creating a lot of frustration in the market, especially among the hedge funds, is copper. We've seen funds go in and out of long positions and short positions all year. You can see it on the chart here. We've been range bound all year, well into last year almost. And just last week triggered the biggest net selling on record, because we went from a long to a short. And following these manufacturing data, you can see the market's now squeezing higher again. So a lot of this is driven by positioning, wrong positioning by funds, just to trying to look for the next direction. And so far we're not getting it. We're still stuck in the range. On the Brent crude, issued this seller there yesterday. It's got quite a short time horizon. Went short at 51.10. We didn't make it back above yesterday, so we have a relatively tight stop on that, 1.25 away from entry, targeting 49.40 and 48.40. The reasons are there, and you can also read about on tradingfloor.com. And finally, just highlighting that we got webinars this week. I'm doing one on commodities later today. You can sign up by clicking on the link up here, and George will continue his weekly updates on weekly option labs on Wednesday. That's it from me. I'll pass you over to Michael on bonds.
All right, thank you, Ole. And in the fixed income market, the Fed speak that we heard overnight basically confirms what we talked about yesterday, that the rate hike guidance for December is very much live. The probability has improved to 71% now, but the market seem pretty well versed with this scenario, although treasuries were a bit softer overnight. We have the 10-year US yield at 1.75%. It's basically been range bound at this level for the last couple of weeks. In Europe this morning, or in the later part of the session yesterday, we saw Bunds losing momentum a bit, maybe this as well. We have the Bund future currently at the 164 level, so taking yields, the 10-year yield back into positive territory. And it is this QE issue, I think, looming in the background. December meeting in the European Central Bank is a long way ahead of us, but this meeting is certainly shaping up to be a huge event with a decision on QE, which could basically go in either direction. They could either extend it or indicate a decision to taper programs. That's going to be a very interesting one, and we're going to see a lot of speculation. We talked about yesterday also the outperformance in Spanish markets after the resolvement on the political or the non-government there in Spain over the weekend. We're also seeing, as Dan mentioned, a lot of about this Italian referendum, constitutional referendum. Also in early December we had an opinion poll yesterday, which pretty much a dead heat. Yes vote at 35% and no vote at 38%. So quite a large part undecided as well. So this one's going to be very interesting as well. If we look in the European government bond market, we can actually see just from the spreads to Germany 10-year yields here that Italy, the white line here, has widened quite a bit compared to Spain, for instance. Quite a gap there. But in absolute terms, the Italian 10-year yield is at 1.38%. That's still relatively low. I would expect the potential for some more uncertainty incorporated here, and the way to say that is by shorting the future, hedging it by going long one future. So that might be an idea for next month here as referendum. That's everything from us today. Thanks for tuning in.
Thank you, Michael, and thank you all for joining us. We will live tomorrow, 8:40 CET. Have a nice trading.